Hey friend, Steve here. Today, we're going to answer the question, am I too old to get a whole life insurance policy that still has a lot of cash value? What we're going to look at is a situation of someone that I'm working with right now who's 68 years old. He has a lot of money in different investments. He's set for retirement, but he's still interested in a whole life insurance policy if it's set up right. So let's take a look at the details of his situation. So to kick things off, he's 68. He has a lot of money in retirement accounts, and from an income standpoint, he is good for the rest of his life. Now, why he's interested in a life insurance policy is because he has $2 million in term life insurance that is set to expire in a couple of years. He recently looked into whole life insurance, but he didn't do it for two main reasons. One, he would have taken a huge loss up front. And two, he would have to wait 10 years just to get his money back. Now, what I mean when I say that is that he looked at a life insurance illustration, he saw premiums going in, and he saw less in cash value than what he paid into the policy until the 10th year, meaning he ran a loss for the first 10 years, which if he's starting at 68, that means he's negative until he's 78 years old. He's like, yeah, I'm not doing that. I have zero interest in that. I'm like, no problem at all. We did not show him that, by the way. So his goals are as follows. He has investments, but he also has $1 million in conservative accounts, and that's what he was interested in using to fund his whole life insurance policy. So what he specifically wants to know is, can I earn a return on my $1 million with this whole life insurance policy and still have $2 million in life insurance? If I can use my current $1 million to get both of those things, I'd be interested, taking into account that I am 68 years old right now. And again, to reiterate something, if the cash value is not attractive, I'm not waiting 10 years to get my money back. No problem. I wouldn't wait 10 years either. So in his case, what I thought was interesting is he's in a situation where he doesn't need the $1 million. He's got healthy assets. He knows different investments and what to do with his money. He's a retired CPA, really, really sharp guy. But seeing the $1 million there, just knowing that it's available, gives him peace of mind and puts him in a situation where he says, I feel better about it. Like I have to have that there. If it's not there, I'll do something else with my money. And that's okay. Here's what I would do if you ever express similar goals to that. So the first thing I would do when it comes to setting up the policy, if we're 68 years old and we're working with $1 million, I would look to move that $1 million into a policy over a 5-year period, which is $200,000 per year. And why 5 years has to do with his age. At 68 years old, the sweet spot, meaning getting the perfect balance of maximum cash value up front, long term, and having the greatest death benefit long term, is going to be 5 years. Meaning if we were to look to move $1 million into a policy over 4 years, which would be $250,000 per year, you'd see a little bit more cash value up front, but by the time you hit the 5th and 6th year, you'd have less. The expenses would be too high. Generally, you will find that as the older we are, it makes more sense to spread a lump sum payment out over a longer period of time. In our late 60s, it's usually over 5 years. So, step 1, I would fund the policy over a 4-year period. Step 2, I would consider one of your 4 major mutual companies, who are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. The simple reason why is because they can provide proof of performance. When I look at real whole life insurance policies that have lived the test of time, I have seen the greatest long-term results from a cash value and death benefit standpoint with those 4 companies. What I've seen in my short career and being in this industry for almost 15 years now is that some agents will attempt to justify going with a smaller life insurance company because they look the best on paper. The issue that I have with that, and this is just me personally, is when I look at smaller companies, I have not seen proof of performance. So I'm showing you good looking numbers on paper, but if it under delivers, that's a loss for you. And then also, when it comes to smaller companies, in the majority of cases, they do pay higher commissions. At least a lot of them that are out there in the whole life insurance space, meaning significantly more in commission than what you'll see with the four major mutual companies. I just have a hard time advising someone to go into a life insurance product when they're interested in cash value, where I make more and I don't have the concrete proof that they are going to have more as a result of going with that smaller company. So step one, fund the policy over 5 years. Step two, go with one of the four major mutual companies. Step three, build in flexibility so we can easily make adjustments after starting the policy. So what I mean when I say that, funding the policy with $200K per year, he's not going to be billed for $200,000 per year, meaning his minimum premium commitment will be closer to $20,000 per year, and then the other $180,000 will go toward our paid up additions or PUA rider. This is how we accelerate the cash value growth, but we'll set it up where it's optional. He does not need to pay at the same time as he pays the premium. He's not required to pay the $180 per year. Some years it could be less. Maybe it's $100K, some years it's zero. It's very flexible and he can add it whenever he wants. This prevents him from feeling like he's going to get a big bill from the life insurance company. And then the next flexible piece, the death benefit. We're going to have an option where he can reduce the death benefit at year 8, and this will improve the cash value performance quite a bit. When we look at the numbers, specifically the side-by-side comparison, you're going to see this. It'll be pretty cool too. So, company and product selection. I mentioned the four major mutuals. At the age of 68, I'd lean toward Guardian. The main reason why is because it's much easier to reduce the premium expenses with Guardian, specifically the base premium and cost of the term insurance rider, than what we can do with other life insurance companies. So I like them, especially for people who are a little bit older, because we can push those costs down lower. The products we're going to look at are first, Guardian's L95 product, specifically with their 5% PUA fee. This option is great for very attractive upfront cash value. Second, we'll look at the same L95 product, but with a 10% PUA fee, which is decent upfront, but it does provide more cash value from a long-term perspective compared to their 5% PUA fee. And then 3, we'll also look at their 10-pay product, which will give the most cash value and death benefit long-term. Let's take a look at the numbers. So all of the numbers are pulled from these guys. These are the formal illustrations with Guardian. We've got their L95, 5% PUA fee. How we can tell it's the 5% PUA fee is if you see STP on the illustration, that means it's their 5% PUA fee. But you can see on page 3 of an illustration, the 5% charge. When we look at the 10% PUA fee, if you don't see the letters STP there, that means it's the 10%. You'll see the same thing on page 3. In fact, let's go there really quick. There you go. There's the 10% charge. The justification of a higher PUA charge is the company's going to take more money from you up front, so you will have less in cash value up front, but they should be able to give you more from a long-term perspective, because the reasoning is you're giving us that money and we, the insurance company, can go out, earn a high return, and then we'll give that back to you in a greater dividend. It's all non-guaranteed though. Higher PUA fees typically result in lower guaranteed cash values. And then we also have the 10-pay product. Now, quick side note with the 10-pay product, it does carry a higher minimum premium. If we look at Guardian, all of their products except for the 10-pay allow a minimum premium of just about 10%. It's a little bit less than that. Meaning, if I wanted to be able to pay $200K per year, I could have a minimum premium commitment of very close to $20,000 per year. The true minimum, the base premium, is about $18K. When we add the term rider, in this particular case, base plus term Comes out to a little bit more than $20,000. The 10K works a bit differently. Guardian allows us to illustrate only 5 times the base premium in PUAs, which results in a bit of a higher base premium. We also have a term insurance rider attached, so the true all-out minimum or all-in minimum is about $37K when we look at the 10Pay product. So that is a drawback to some. So let's take a look at the side-by-side comparison, shall we? This will be fun. First, his goal of the $2 million death benefit. Let's start here. Here's our L95 policy with the 5% PUA fee. The minimum premium represents the base premium plus the term. Rest goes into PUAs for a total annual outlay of $200K per year. The break-even point. Do you remember what he originally was turned off by? A big loss up front and 10 years to get his money back. Here, he gets his money back at year 4. He's starting at 68. A lot of times, people who are older see this and say, I had no clue that that was possible. Now, the death benefit of $2 million. We kept it at $2 million, and eventually it does go up. So I just want to explain what's going on here, and then we'll look at the second option, which involves reducing the death benefit. So here's our L95 policy. This is what we just looked at on Excel. You fund $200K per year for 5 years. After that, you fund 0. Okay, cool. Look to the far left. Here's your premium. It's due up until age 95. Now your after-tax outlay is 0. So you're not paying the premium at all. How it's being paid is through the dividends and interest of your policy. That is covering both the premium and the cost of the term insurance that is still attached to your policy, which does result in some drag if we're looking at the cash value growth. So what we're going to look at is the exact same policy with that after the fact change where we talked about the flexibility earlier. So here's the exact same thing, but look at this. After year 7, the premium is gone. What you'll also notice to the far right, the term insurance rider is gone, and the net death benefit, which is what's paid out if you were to pass, also takes an initial drop. So we are reducing the death benefit here, but what do you get in exchange? Like, why would I do this? Or why would I even show this to him? Here's why. When we compare the two side by side, how much more do you have in cash value? For the first 7 years, it's nothing because they're the exact same product. But from the 8th year onward, once we reduce the death benefit, you see a lot more cash value. The death benefit follows a similar pattern. However, when we do drop that death benefit, if you were to die up until about 85, less would be paid to your beneficiaries. So, which one would you choose? You don't have to choose up front. That's the nice thing. You can play it out as the years pass. Year 8 is the earliest you can make this adjustment. But it's a nice option to be aware of because it does provide more cash value, which most people that I speak with are interested in. All right, so let's next compare this guy with the 10% PUA fee, shall we? So what we've got here, the 5% PUA fee we just looked at, breaking even year 4, fantastic, compared to the 10% PUA fee. Your break-even point, just about year 5, really cash positive in year 6. So that higher PUA fee does result in less cash value up front. Look at the difference there. You're less for the first 10 years by going with the 10% PUA fee compared to the 5% PUA fee. But from that point forward, you do have more with the 10% PUA fee based on the current dividend rate and the non-guaranteed values. If you looked at the guaranteed values, the 5% PUA fee would have more. There's your death benefit difference as well. 10% PUA fee has more money long term, but they're both the same product, same minimum premiums of $22,000. So if he likes the idea of a low premium commitment, but more cash value long term, the 10% PUA fee is a nice option. Now let's compare that, the 10% PUA fee, with the 10-pay product. So biggest drawback to this, upfront hit on cash value. He pays $200,000, he takes a $40,000 hit. If you circle back to the 5% PUA fee, the first year cash value was $174. It's only a $14,000 hit. So we're seeing the difference here. The break-even point is between years 5 and 6 when we look at it. So not that great up front. But from a long-term perspective, it does cook. So again, what we're comparing here is the 10% PUA fee and the 10-pay product. 10% PUA fee gives you more long-term compared to the 5%. 10-pay gives you the most long-term. So what we also do in situations like this is show everything side by side, just to make it simple to go through. And again, this is a former CPA. He likes the numbers, so we also included the annual yield. In his case, we also included the internal rate of return, so we can look at the averages. But look at this. I'm just going to direct your attention to this piece, the annual yield. Look at it down here. This is the option where you kept the death benefit at $2 million. This is your 10-pay. Have that in mind. Peaks at what? Call it 4.2%. What happens when you look at the option where we drop the death benefit? Different story. Peaks at more than 5%. So you do get more juice when we exercise those options. But again, we can choose, which is really, really nice. So which one will he choose? It's up to him. Can't tell you that. And just like we can't tell anyone, but I'll always give you my advice and let you know which one I would choose if I'm you after we talk for a bit and we get to know your situation. So how does this help him? Well, in summary, the cash value continues to grow safely. It appreciates with no market risk at all. He can access it on a tax-free basis for any opportunities. If he says, I'd like to invest in some real estate or get into a business venture with my son, I'm interested in that, he can tap into the cash value for that, and it keeps on compounding while he does that. Or he can access it on a tax-free basis to supplement his income. A lot of people we work with will do that. That's the cash value. How about the death benefit? Well, this helps him in the sense that the death benefit is paid 100% income tax-free to his family. He replaces the term insurance effectively. He doesn't have to worry about that $2 million not being passed now. And he used $1 million that he had in conservative accounts to accomplish this. So he gets a return on his million, and he leaves double that to his beneficiaries. If he drops the death benefit, yeah, it'll be a little bit less for a period of time, but you kind of see what's going on here, how we can leverage this. So what we did here is diversify his assets further and optimize his entire situation from a short-term and long-term perspective. He has Roth accounts. He has other investments where he can position his aggressive investments there. And now he also has life insurance, which provides conservative growth, tax benefits on the cash value, and leaves a tax-free legacy, which is very, very nice. Basically, when we're working with individuals, what I like to do is run the balance sheet just like a corporation, meaning your strongest corporations last for generations. A lot of families do the exact same thing. A lot of corporations and banks that we work with have a lot of life insurance on their books. It's for the cash value and the long-term death benefit. Families will do the exact same thing. So all we are really doing is copying the model that so many large corporations and institutions practice, but on a individual level. Hope you enjoyed this video. If you'd like to see another one like it, you can check out this one here.